how a home equity line of credit works. I can't believe I've done almost 1,000 videos, if not 1,000 by now, and I have not done one regarding home equity line of credit, HELOCs, if you will. It's nuts because it's a big deal. I just can't believe it. So anyway, I'm going to do it here today because no one understands how this works, and just is frustrating to win. This is one of the benefits of coming from a banking background. So to you thinking about going into financial advisory and you're thinking, how do you get a start? I'm telling you, go to a banking, be on the platform of a bank for a couple of years. I'm telling you right now, that's the number one way to learn because you got to understand the debt side of things. And if you don't, and you're just focused on the investment side or the insurance side, you're missing the vast majority of what affects people, which is the debt side and homes, because everyone has a home. All right, so let's dive right into this. Dave Ramsey and others say, don't do reverse mortgage, go to home equity line of credit. I can tell you, that's just foolish. So let's talk about this. So take our trusty PVC pipe, and we're going to show you. A husband and wife have a home, anybody has a home with $250,000. They have no mortgage on it, all right? No mortgage, home equity, home of $250,000, which means their equity is what? Value is $250,000, no mortgage. Their equity is $250,000. Now they got a flyer in the mail that says they can borrow 80% of the value of their home. So 80% of $250,000 is $200,000, which is an 80% loan to value. Now, I saw one, who was I looking at before I did this video? Chase or something like that had a 95% loan to value on a home equity line of credit. And I was stunned by that because that's going back to where we were pre-Great Recession. I'm telling you right now, I used to get flyers all the time. I think even USAA had one that said like 105% loan to value because everyone, the smart guys, remember these are all the smart guys. They all thought that the real estate market keep going up and up and up. So when they hear these guys, the smartest guys in the room, just ask them, they'll tell you. You just can't listen to their prognostication because they don't know any more than you and I. All right, so here we have $200,000 is the amount we could theoretically borrow against to get an 80% loan to value home equity line of credit. So you're sitting there saying, I'm listening to Dave Ramsey. Screw that guy, Josh. Dave Ramsey tells me what it is. I'm getting a line of credit, home equity line of credit. I'm not taking a reverse mortgage. That guy, Josh, doesn't know what he's talking about. I'm going to get a $200,000 line of credit. Even if I don't use it, I'll have access to it so that way I can age in place. Yeah, okay. Let's talk about this. Now, initially, you said, I'm not even going to borrow against. I'm just going to take a $200,000 line of credit. Be no debt outstanding on it. I just want it there accessible for me in the future. All right. So now, this is you. You got $3,500 a month in income. It could be from required minimum distributions. It could be from Social Security. It could be all from Social Security. It doesn't matter. You got $3,500 a month in income. Now, here's the problem with RMDs. How's the bank going to calculate your RMDs? Because they're not, even though you have to take RMDs, they're not set on a fixed pattern. They're not, because the value of the markets could go up and down. So the bank's going to say, okay, I see you got 10,000 of RMDs last year and you had 8,000 the year before. How are they going to calculate it? Interesting. I know they'll probably look at your 1040 and they'll get a gauge what your 1040 shows, but I'm just telling you right now, just because you say you have a significant amount of RMDs, required minimum distributions, anything that's not fixed, Social Security, pension income, annuity income, anything that's not fixed challenges the bank a little bit because that could go away. And they're certainly not going to look at your interest dividends that you received off your checking and savings and investment accounts as a sure sign that you can qualify. But let's just say in this case they do. So you got $3,500 a month in income, $42,000 a year. And you're saying, I want to borrow $200,000 line of credit. I have no other debt, none whatsoever. That should be no problem at all because I'm not even going to borrow against this line, am I? Well, here's how it works. The underwriting will say we're going to have to charge your minimum monthly payment is going to be 1% of outstanding balance. Outstanding balance. 1% of outstanding balance. Well, here you have no outstanding balance. You're not going to borrow anything, so your minimum monthly payment would be zero. No big deal, right? Because you're not borrowing anything. That's once the loan is approved. To get it underwritten, 1% of a line amount is how you have to be able to support to get it underwritten, to get it approved, is 1% of the line amount, which is $200,000. All right. So if we have 1% of 200,000 bucks, I'm going to take my trusty calculator here just to make sure I'm not crazy talk. I have a feeling that's going to be $2,000. $200,000, right? 200,000. Can you see that? We're going to do times 1%. Our payment's going to be $2,000 a month. All right. So here's our monthly payment. $2,000 a month. Oops. Didn't need that. $2,000 a month. That's going to be our monthly payment. So what we do is they take $2,000 a month, divide by $3,500 a month, which is our income, and it's going to be bad. Equals our debt to income. 2,000 divided by 3,500 is 57%. Let's get 57% debt to income. You're not qualified. You're not going to get approved for that. You're just not, because your debt to income is too high. The bank will look at your debt to income. They don't want it to be more than 43%, depending on the bank, the aggressiveness of the bank. Most banks, it used to be 36 to 42. You're not going to get that $200,000 line of credit. But Josh, I'm not even borrowing against it. Bank doesn't care. You could. So now let's make this $100,000 instead. All right. $100,000 might be more reasonable. So we're going to make it $100,000. It's 1% of the line amount equals $1,000. That's our monthly payment. To support, we got to have enough debt to income to support that $1,000 a month payment. So again, we go 1,035. Was it? We have 1,000 divided by 3,500. Actually, let me make that look prettier. That looks ugly. To get our DTI, so what does it say? 1,000 divided by 3,500. In that case, we'll probably be able to support that right there. Divided by 3,500, and that debt to income is 28%. Okay, good. So yeah, 28% there. So in this case, we're able to borrow, what's that? Not 80% home to value. What's that? 40% home to value, or loan to value, I should say. And so that's fine. I mean, so now we can afford a 28% debt to income ratio. We can get approved for that because we're only borrowing $100,000 our line of credit, even if you don't borrow anything. That's a far shot off from $200,000, is it not? Now, let's say you have a car payment at $350 a month. All right, so we have a car at $350 a month. All right, so now we take our income, subtract by our $350 a month, and that's going to give us $3,150 is the amount we have to service the debt, $3,150. Let's go back to where we had a $100,000 line of credit. LOC, line of credit, which is $1,000 a month. So now, I mean, basically, we'd even do it even easier than this. What we can do, we'll just say we have $1,000 a month for this, plus that. $1,350 is our debt, divided by $3,500 a month is our income. That should give us about, what, 35% there? So we got $1,350 divided by $3,500 a month. That's now we're getting up there. That's about 38% DTI. So depending on how aggressive your bank wants to be, that might be tough, especially if your credit's not that great. So here, with a car loan that we have outstanding, we're certainly not getting $200,000. We're probably able to squeak by with a $100,000 line of credit. Now, what they'd probably say, and I would actually somewhat agree with this, if we roll that loan into the home equity line, and that's what happens when I was in banking. We just pay this guy off right here to eliminate that $350 from your debt to income, and then you just have a debt to income ratio based on the $1,000 a month. If that makes sense. That works in terms of getting under it. A good banker can do that. It's easy. But as you can see, it doesn't take much to get a quickly up there to a higher debt to income that you can qualify for. So Lastly, let's say, oh man, this is going way back. We got a mortgage, no, $500 a month. You got a mortgage. You only owe $50,000 on your mortgage, so you have $200,000 of equity. All right, so now we got you're paying $500 a month on that mortgage. On the mortgage plus $350 car loan. All right, so we got, what's that? $850 is your current debt that you have outstanding. There's no way you're gonna get anything. So you take 80% of this right here. Now would give us $160,000 at the max. Max line that we could borrow. So we could borrow $160,000 against the $250,000 if we have $50,000 mortgage outstanding. So $160,000 is the max line, but you already have $850 a month going out to debt. So now we add $1,600 to that, plus $1,600 for that right there. And that's going to get $2,450. Divide by going to happen. $2,450 divided by 3,500. Now your debt to income is 70%. No bank's gonna give you that. No bank's gonna give you that unless you want to use this right here to pay off that mortgage and to pay off that car loan. Now, if you do that, you'll find. But now you're taking a. Don't do that, because this mortgage, if you've had it for so long, you're essentially paying all principal back. I mean, you've already most likely have paid all your interest for the most part. On top of that, you're taking a car loan that would be paid off in a couple of years and adding it to this line of credit that's variable rate. It's probably higher interest than the car loan to begin with. This will certainly be higher interest than your mortgage debt. Oh, but I can deduct it. No, you can't. You're not deducting it with that kind of income, man. You don't make enough. You have no deductions. I mean, stop. If we're only making that kind of income in retirement, home equity lines of credit are not deductible because your standard deduction is so high, there's nothing to deduct. You're not making enough interest to make it deductible over and above your standard deduction. So there's no benefit here whatsoever. And this happens a lot. I've had this a million times in my experience. Retiree with a small amount of mortgage, only $50,000 outstanding, not a huge amount. A car loan, but he's still paying a couple $100 on his mortgage, paying a couple $100 on his car loan. And he wants to do a line of credit because he heard Dave Ramsey says reverse mortgages are scams. And I said, okay, well, let's run the numbers. We don't want to refinance this debt. That's bad. Anyone who does that is bad. Because you're already so far into it, most likely. You're on the precipice of even going downstream in terms of how it's work, in terms of the graph, the bell curve. I mean, you're paying interest, and then you start paying principal like crazy once you get on the other side of the bell curve. And here you're far on the other side of the bell curve. You're essentially paying no interest, regardless of the interest rate is, by the way. So to take that off the table to put into this so I can qualify for a line of credit, that's just bad planning, because now I'm paying a significant amount of interest up front. On top of that right here, I'm paying a car loan off, which will be paid off in 2 or 3 years anyway, and it's a lower interest rate most likely anyhow. Don't do that. Now, that would allow you to qualify for actually even more than $160,000 line of credit, well, because you're paying off this mortgage, but I mean, that doesn't make any sense. I just don't do that. And yet, I'm telling you, bankers do this stuff all the time. Well, if you take this, take that, take this, take that, and all they're doing is looking at this right here, your debt to income. How can we pay off a debt in order to consolidate into this line of credit? That way you can qualify. Just don't do that, man. Don't. So in this case, you're stuck. You're like, well, I can't take a mortgage. I can't take a home equity line of credit because A, I can only borrow $160,000 to keep my loan to value at 80%. B, I'm so deep into my mortgage anyway, stupid to pay that guy off. C, I shouldn't take a home equity line of credit in order to finance the car because my interest rate on the car is low, and on top of it, it's not variable, and on top of that, it'll be paid off in a couple of years. But I have all this equity, $200,000. What can I do with it? Well, you can't do a home equity line of credit because you're not going to qualify. You have 70% debt to income ratio. Even if you went down to $80,000 here, which would make it an $80,000 line. All right, let's just go to $80,000 here. $80,000 line. It's still gonna be $800 you gotta be able to carry, because the bank, they just say, look, we're gonna loan you $80,000. You might use that tomorrow to go to Las Vegas. We gotta carry our debt. So we got we gotta erase that guy too. Here we got $1,650. Oops. Is our monthly debt coverage. All right, so we got $1,650 divided by 3,500. That gives us 47%. So we came and get $80,000. We might be able to get $60,000. But I mean, remember the whole point was we don't want. The whole point was tapping your equity so you can stay age in place without having to do a reverse mortgage because they're scams. Anyway. That's how home equity lines of credit work, my friends. I just don't do a home equity line of credit in retirement. I'm telling you, man. Now, if you can afford it and you just want the line available to you, by all means, do so for sure. But don't use it to consolidate debt. Don't use it as a way to pay for cash flow that you couldn't otherwise afford, because you still got to pay this back. Now, the monthly payment is 1% of the outstanding balance, not 1% of the loan amount. It's 1% of the line amount, is 1% of the outstanding balance. So once you get the home equity line approved, it actually is a lot more reasonable to get it approved. But to get it underwritten, it's 1% of the line amount. Secondly, if you're going to stay in your home in retirement, don't close out your home equity line of credit because you've already been approved. And I'm telling you, going through the underwriting again, once your cash flow drops off like a brick in water, it's a big mistake. Don't. So don't close it out. Just keep it with no balance. You know, some banks will say you got to put $100 or something like that. Okay, we'll do that. But don't close it out, because it's going to be tough to revisit this again when your cash flow drops, because the banks will say, can you qualify for a 1% monthly payment on the line amount, $100,000, as opposed to the outstanding balance? And the answer is probably not. And then what are you going to do? Well, that's where the reverse mortgages really comes in beneficial for sure. All right. Hope this helps. Don't forget to subscribe, thumbs up, comment, and let me know what you thought. Thanks now.